In the summer of 1945, a city of 4 million people had no working economy. Berlin's factories were destroyed. Its banks were closed. The Reichsmark, officially still legal money, bought almost nothing because the farmers who grew the food refused to accept it. They had watched the government print money for 6 years to fund a war. They knew what a government's promise was worth. So the city improvised. By July of that year, 2 outdoor markets had established themselves in Berlin almost on their own, one in the Tiergarten, one at Alexanderplatz. They opened as soon as American and British soldiers arrived. No government created them, no official authorized them. They simply appeared. The way markets always appear when people have things other people need. At those markets, you could exchange a fur coat for potatoes, a lamp for cooking oil, a set of encyclopedias for a pair of shoes. American journalist Joel Sayer reported on what he saw in the July 28, 1945 issue of The New Yorker. A pack of 20 American cigarettes was trading at 300 Reichsmarks. A single cigarette, one, was worth between $1.50 and $2 at the official exchange rate. For comparison, a pack of American cigarettes cost 5 cents at the U.S. Army PX. The price difference is the entire story of the underground economy in a single number. The official story of post-war Germany is a story of rebuilding, of the Marshall Plan, of currency reform, of Allied administration slowly restoring order to a devastated nation. The documented record tells a different story. It tells the story of what Germans actually did between May 1945, when the war ended, and June 1948, when the Deutsche Mark finally replaced the Reichsmark, and the parallel economy collapsed overnight. What they did was build a second economy without permission, without government oversight, without any of the institutions economists say are necessary for markets to function. And for 3 years, that second economy fed more people than the official one did. The academic paper that confirmed this was not written about Germany. It was written about a prisoner of war camp, and it appeared in print in the autumn of 1945, just months after the Tiergarten market opened. R.A. Radford was a British Army officer trained in economics at Cambridge who had been captured in North Africa in 1942 and spent the remainder of the war in Stalag 7A, a prisoner of war camp in southern Bavaria. During his captivity, he did what economists rarely get to do. He watched a brand new economy build itself from nothing in real time among people who had no choice but to participate. His paper, The Economic Organization of a POW Camp, was published in the journal Economica in November of 1945. It became one of the most widely read economics papers of the 20th century because what Radford documented was not an anomaly, it was a confirmation. The prisoners received Red Cross parcels containing food, clothing, and cigarettes. The parcels were not perfectly equal. Some prisoners received more, some less. Almost immediately, trading began. A prisoner who hated coffee would trade his ration to someone who wanted it. A non-smoker would trade cigarettes for chocolate. Within weeks, prices had stabilized. Within months, a basic price board existed in the barracks, listing the going rate for every tradable item denominated in cigarettes, which had emerged as the camp's default currency. Radford noted in the paper that cigarettes became the unit of account because they satisfied the basic requirements of money. They were uniform, portable, divisible, and widely desired, even by non-smokers who understood they could trade them. This was not a planned system. No one decided cigarettes would be currency. No committee voted on exchange rates. The market emerged because the alternative, failing to trade, meant worse outcomes for everyone. The incentive was survival. The institution it produced was functionally a complete economy. Radford's observation was specific and documented. The economy of the camp did not require a state, a central bank, or legal authority. It required people with differing needs and the freedom to exchange. The Germans in the Tiergarten had exactly the same needs and exactly the same freedom. The scale of what developed in post-war Germany is documented in American occupation records and in post-war German economic scholarship. By November of 1945, 6 months after the war ended, the black market was supplying an estimated 20% of Germany's food. By June of 1946, that figure had reached 50% in some categories. Not the fringe of the economy, half of it. Companies had adapted because fixed prices and Reichsmarks bore no relationship to the actual cost of inputs. Firms began demanding payment in kind from their buyers over and above the official price. A coal company wanted coal in return, not Reichsmarks that could not buy replacement equipment. Firms paid their workers in kind too. Coal miners in the Ruhr received part of their wages in actual coal, an arrangement the Germans called Deputat Kohle, the coal allowance. Miners then exchanged that coal on the market for food, clothing, and medicine. Their pension, in some documented cases, was also partially paid in coal. This was not primitive barter. It was a sophisticated system of commodity-denominated compensation that bypassed a currency everyone knew was broken while still operating within the legal structure of employment, production, and delivery. A poll conducted in the American occupation zone in May of 1946 found that 18% of respondents reported traveling to the countryside regularly to acquire food directly from farmers. City dwellers would load up whatever portable valuables they had, books, lamps, kitchen pots, china, and ride the train to rural communities, trading household goods for potatoes and flour. Farmers refused Reichsmarks, but would accept almost anything else. The markets in the Tiergarten and Alexanderplatz grew to serve specific needs. Railway tickets, identity documents, pharmaceutical supplies, black market cognac, and cigarettes, always cigarettes. American soldiers discovered that a carton of American cigarettes purchased at the Army PX for $1 could be sold in Berlin for $200. A carton for $200. An SSU intelligence report from January of 1946, now archived in the National Archives, documented the going rates precisely. One American wristwatch was trading for $1,000, a 5-cent chocolate bar for $5, a pair of army boots for $200. The Stars and Stripes military newspaper reported in August of 1945 that the 33,000 U.S. troops stationed in Berlin had sent home $4 million that month. Their total monthly payroll was $1 million. The gap was the black market. The parallel economy ended, not when order was restored, but when the currency was replaced. On June 21, 1948, the Allied powers introduced the Deutsche Mark. Each German citizen received 40 new marks. Old Reichsmarks ceased to be accepted almost immediately, and within days, the author Dorothea von Fulda-Larsen recorded in her memoir, the markets had changed entirely. Goods that had been invisible for years, sitting in warehouses, hoarded by producers, waiting for a currency worth accepting, suddenly appeared on shop shelves. The cigarette economy died in a week. The lesson is precise. The parallel economy had not been filling a permanent gap. It had been filling a temporary one. The gap between a broken official currency and a replacement that the population could trust. The moment trust in an official medium of exchange returned, the informal alternative became unnecessary. Not because anyone ordered it dismantled, because it had served its purpose. The second case is closer to living memory, and it carries a warning the German story does not. In December of 2001, the Argentine government froze bank accounts. Overnight, middle-class families who had worked for decades to accumulate savings found that the money existed in their account records, but could not be withdrawn in amounts sufficient to live on. The official exchange rate was fiction. The official banking system was closed to them. The response was not to wait for the government to fix it. In Quilmes, a neighborhood outside Buenos Aires, a group of 3 people, Ruben Rivera, Carlos de Sanso, and Horacio Covas, had been running an experiment since 1995. They had started a barter club with 23 members. The idea was simple. Each participant was both a producer and a consumer, a prosumer in the Spanish coinage, who brought something to the exchange and took something away. A doctor could offer medical consultations, a seamstress could offer alterations, a farmer could offer vegetables, a mechanic could offer labor. To solve the double coincidence problem, the classic barrier to barter, where you need to find someone who has what you want and wants what you have, the club issued its own printed currency. They called it the credito. 1 credito, 1 peso. You earned creditos by providing goods or services. You spent them acquiring goods and services from others in the network. No bank, no central authority, no interest. By 1998, as recession tightened, the clubs had spread across greater Buenos Aires. By early 2001, there were 1,800 nodes in the network across Argentina. When the bank freeze hit in December, the clubs did not merely grow, they exploded. By May of 2002, 5 months into the crisis, there were 5,000 nodes operating across the country. 2 million people were active participants. Estimates from various academic sources, including a survey cited in research from Harvard's economics department, put peak participation across all barter club variants at somewhere between 4 and 6 million people by mid-2002. Ruben Rivera, one of the founders, described what happened in October of 2001. A flood of people driven into poverty by the crisis found no functioning state social safety net. So the clubs decided to open their doors. The requirement that new members take an orientation course and have something to offer was relaxed under the pressure of desperate need. And that decision, made out of solidarity, made because the alternative was people going hungry, is what killed the system. The credito was not a hard asset. It was a social contract. Its value rested entirely on the network's collective agreement that each member would contribute proportionally to what they withdrew. When 2 million people entered the system in a matter of months, many of them in genuine desperation with nothing to offer, the balance broke. New members received starter loans of 50 creditos without producing anything to back them. The money supply expanded. The trust that had governed the original small clubs did not scale. Counterfeiting emerged. Multiple networks had begun printing their own credito variants, and some issued far more than their capacity to back. By mid-2002, the parallel currency was experiencing its own hyperinflation. The 3 founders of the original Bernal network were arrested and charged with illegal currency creation. The arrests combined with the currency collapse ended the experiment. By the end of 2002, the clubs had contracted as rapidly as they had expanded. The Argentine government extended unemployment insurance to 2.5 million people, providing access to pesos rather than creditos, and the parallel currency lost its function. The Argentine Truque network succeeded where it remained small and local with strong social bonds between members who knew each other and could monitor contribution and withdrawal. It failed when it scaled beyond the point where those social bonds could function. This is not a story of a good idea that was poorly executed. It is the documented limits of what parallel economies can do. So what does the forensic record actually show about what worked and what does not work in a parallel economy? The first mechanism that worked in both Germany and Argentina was the immediate translation of skills into currency. In post-war Berlin, a locksmith could open doors for neighbors whose keys had been lost in the bombing and receive potatoes in return. A seamstress could repair clothing for cigarettes. A doctor in the Buenos Aires Trueque network could offer consultations for creditos and spend those creditos at the vegetable stand next to her in the fair. The mechanism in both cases was identical. A skill that already existed became the basis of economic participation outside the broken official system. This is what the documented record confirms across every monetary crisis this channel has examined. Human capital, the ability to produce something others need, is the one asset that cannot be confiscated, cannot be inflated, and does not require the permission of any institution to deploy. The second mechanism was commodity money, and specifically the use of commodities that satisfied money's basic requirements. Cigarettes in Germany succeeded because they were uniform, portable, and divisible. You could break the transaction into fractions. 1 cigarette, 5 cigarettes, a pack. Coal in the Ruhr worked as partial wages because its heating value was measurable and its exchange rate against food was knowable. The mechanism applies today anywhere official currency becomes unreliable. The commodity that functions as currency in any given crisis is the one that is widely desired, physically uniform, and resistant to counterfeiting. In 1945, Germany, that was American cigarettes. In the camps, Radford documented it was also cigarettes, specifically factory-rolled ones, because hand-rolled cigarettes were not uniform enough to be reliable. The uniformity mattered as much as the desirability. The third mechanism is the one the Truque story illuminates most sharply. The parallel economy that survives a crisis is the one that was built before the crisis, at small scale with social accountability between members who know each other. The Quilmes Club had been operating for 6 years before 2001. Its founding members had built trust across hundreds of transactions before the bank freeze made it essential. When the crisis hit, the club had a functioning structure it could scale carefully. The clubs that expanded fastest, that accepted anyone, that printed creditos without discipline, collapsed first. The modern parallel is uncomfortable but precise. A neighborhood where people already know each other's skills, already trust each other's word, already have some history of informal exchange. That neighborhood has something money cannot buy during a crisis, a functioning social credit system that predates the crisis itself. The people who built that before they needed it are the people whose version of the parallel economy survives. A membership in a community organization, a trade skill known to neighbors, a history of mutual exchange with people in your area. These are not survival preparations in the dramatic prepper sense. They are the documented functional equivalent of the pre-built Truque nodes that worked in Buenos Aires in 2001. The closing observation the historical record demands is this. Every economics textbook that covers this period focuses on the currency reform of June 1948 as the event that fixed Germany. The Deutsche Mark replaced the Reichsmark. Prices stabilized. Goods appeared. The economic miracle began. What the textbooks underweight is the 3 years between May 1945 and June 1948. Someone kept the cities fed during those 3 years. Someone negotiated the exchange rates that made a pack of cigarettes worth 300 Reichsmarks and a fur coat worth a sack of potatoes. Someone organized the open-air depots where goods could be traded, maintained price boards, and kept the supply chains running between city and countryside. That someone was not a government. It was not a central bank. It was not an economist designing an optimal system. It was millions of ordinary people who understood without being told that when the official system stops working, the alternative is not chaos. The alternative is to build something smaller and begin again. Subscribe so you do not miss the next video.